Howdy there, folks, and welcome into today's video. Hope you guys are doing great out there as always. Alrighty, Cathie Wood, talking about Cathie Wood. So saw this newsletter, came out a few days ago on the Hungry Bull app, which is on your iOS store and your Android store now. Way to track your stocks and your cryptos, keep up with the markets, read our daily newsletter, listen to earnings calls, do research, so much more, and so much more coming. So saw this come out this week. Cathie Wood just bought these two beaten down stocks. And so I'm going to react to these two stocks, give you my opinion, and then we're going to talk about a third stock. Now, this third stock is not brought up in this article. However, this is a stock that is actually pretty darn intriguing. Not a lot of people ever talk about this stock for the most part. Of the stocks that are in that space, this is definitely the one that doesn't get talked about very much. So we'll talk about that as well in this video. Hope you guys enjoy this. As always, all I ask in return is that you smash that like button. I appreciate that huge, and that helps out big in the YouTube algorithm, guys. I appreciate that in a big, big way. And let's get into this, guys. So first stock up here, all right? The Permabull queen of investing is back with another multi-million-dollar dip buy this week after reporting a disappointing outlook in this week's earnings call. Zoom, ZM, crashed as much as 16%, leaving Cathie Wood with what she felt was a no-brainer decision. Wood scooped up approximately 200,000 shares of ZM on Tuesday as the stock fell lower, equating to $56 million worth of the tech communications company. Around 157,000 shares were added to the ARK Innovation ETF, while 36,000 went into the ARK Next Generation ETF. Zoom ZM is down about 14% year to date. Even though Zoom beat analyst expectations on earnings and revenue for the previous quarter, the warning of slowing growth and the economic reopening was enough to scare most investors away. And keep in mind, Zoom benefited the most out of probably any public company literally I can think of, right? There are a lot of public companies that actually benefit in their business models. Actually, let's put it this way. If Rona never happened, there's certain businesses that would not be in the position they're in right now in terms of, good. Right? And one of those is Zoom. Like if Rona never happened, Zoom would not be the type of market cap it is today. Zoom would not be as hyped and as talked about a stock as it is today if it wasn't for Rona. But because of what happened there, Zoom has been one of those stocks that's absolutely taken off like crazy over the last 2 years and became a household name pretty much overnight simply because of Rona, right? In an interview with CNBC's Closing Bell, Cathie Wood says, quote, "What we believe is the Rona crisis changed the world dramatically and permanently, and when consumers and businesses find faster, cheaper, better, more productive, more creative, they're not going back to the old world," okay, is basically what she's saying. And I gotta kind of agree with her in respect of, like Zoom, video conferencing of workforces, that's not going away, right? It might go down a little bit in the short term, right? As offices open back up around the world more and more over the coming months and coming year, right? In terms of how much folks Zoom maybe goes down in the short term, but as far as a long-term trend, yeah, I agree with her. Remote work, global workforces, these type of things aren't ending. Freelance economy, they're just going to get bigger and bigger and bigger. And so they might take a step back in the short term, but ultimately they're going to prosper over the long term, right? Now, if we look at Zoom stock here, okay, there's some interesting things. One is the stock is significantly off its 52-week high. Today, or last, time the shares traded $298, under $300 stock. On October 15th, if you're buying the stock, it's at $559. Okay. The stock has been absolutely hammered. There's no doubt about it. If you look at this chart, most of the time it's been over $400, right? And now it's under $300. Look at the market cap for this company, right? $86 billion. That is not a small number. That is a massive, massive number. And keep in mind, 2 years ago, hardly anybody even heard of Zoom. Literally, if you go back 2 years to today, most people, the high majority of people, even in business, had never heard of Zoom, right? You had to be really, really up on things and really, really up on technology to even be aware of Zoom. Now we fast forward 2 years later because of Rona. Zoom is a household name around the world, and especially around the United States, but really around the world, right? Like Zoom, like, hey, you need a business meeting. Hey, send me the Zoom link, right? That is very common. And so it's absolutely incredible that literally in the past 2 years, this company has gone from basically no one knowing of it to $86 billion market cap, right? Now, also keep in mind, there's more and more competitors coming into the video conferencing space, all right, including some big dogs that want to compete. And if you're talking about competing with some big dogs, maybe even the likes of Microsoft, companies like that, not the easiest battles, right? It doesn't mean Zoom can't continue to be the dominant player. It's just you could have potentially some pricing pressure there, right? Because imagine you're a big organization, and let's say you spend a certain amount with Zoom, but let's say there's a free product, kind of free, right? But it's a bundled product with a huge company you already use, and it's no additional cost. All of a sudden, that becomes to be very attractive. Versus, let's say you have Zoom just as a standalone product, and you're spending, let's say as an organization, you're spending $20,000 a year, $50,000 a year, $100,000 a year, and you're looking for cost savings, and you're like, we could save ourselves, amount. These are definitely some food for thought around this. With that being said, I kind of like Zoom. I don't love it though, okay? Price to sales ratio on the stock is 23.76. Now, you almost kind of put Zoom into like a software space because of, how they compete. So if you're going to put in that space, usually the price sales ratios are richer, you have to pay. But yeah, almost at 24, not cheap. Forward P is 66. It's not crazy when you consider Zoom's growth over the next 5-10 years. However, once again, that's not like, this is such a cheap number, especially when you're competing against a lot of big companies, right? And so these are some things to kind of keep in mind here when it comes to Zoom. As far as me, I feel like I need to do some more research into Zoom and really figure out where their long-term opportunity, like where is Zoom going? Is this realistic for this to become a $200 billion, $300 billion, $400 billion company? I would assume Cathie Wood and those folks over at ARK Invest believe so, right? If they didn't, why are they buying this stock? The only reason you pay a 24 price to sales ratio for a stock is if you truly believe that's one of those stocks that's going to double, triple, quadruple, 5x your money over the next 5-7 years, right? And so I'm going to have to listen to these earnings calls. I'm going to have to do a little research on this one deeper, more than just face level. You can't just look at a price to sales ratio and a forward P and be like, it's not a deal or it's a great deal. You got to do a little more digging. So I'm going to do a little more digging on Zoom. I'm going to see if there's something here because it's no doubt the stock's significantly off its 52-week high. Cathie Wood's been buying. The company's definitely in a spot that, those businesses should grow for a long time to go in the future. And, if they continue to see weakness over the next, let's say, 6-12 months, maybe the stock gets hammered even more. Maybe next thing you know, it's trading at $200, $150. And if the company still has an amazing, super long-term future in front of it, those are the things that are attractive to me. You guys know I love to buy beaten down dog stocks. And Zoom's been beaten down, but maybe it has some more to fall as more and more offices open back up. And maybe there's a lot more short-term worries around this one. So more research to be done. It's definitely a stock that has me intrigued. Let me be very, clear about that. There's a lot of stocks ARK and Cathie Wood buy over there that just don't have me intrigued. That I look into and I'm like, nah, it's not, it's one of those business models that I can't even begin to wrap my head around. So it's not worth my time. Zoom is not one of those companies. I can fully wrap my head around that one. Okay. Next up here is Robinhood, the Hood. Okay. Wood has doubled down on Robinhood, ticker symbol Hood, this week, adding 260,000 shares, which is about $11.5 million of value to the ARK FinTech ETF. When the stock tumbled on reports, payment for order flow could be coming to a dramatic end. The ARK FinTech ETF now holds over 920,000 shares of the commission-free brokerage with a value of $40 million. So essentially, ARK's in a position now where they're going to approach 1 million plus shares, and I wouldn't be surprised if over the next week or two they go over 1 million shares of Robinhood. Okay. Now, so Robinhood. Now, keep in mind, this one's only been public for, about 2 months roughly, if it might not even be that long, right? Hasn't been public for very long. The stock, went up like crazy after that IPO. Now it's down quite a bit, right? It's still above IPO. Now, there's a lot to think about in regards to Robinhood. The first is we have to keep in mind that when it comes to Robinhood, they turned off a ton of their clients over the past several years, right? They turned off a ton of their clients. They made a lot of people really, really frustrated. And that's some food for thought, right? And they got a lot of bad press. Now, a lot of this bad press has made some clients that have bigger accounts want to go to other brokerages. And I have honestly, in the private stock group, I've seen it. where, we'll have somebody join, maybe they join and they have $40,000 in their account and they grow it to 100,000 and they grow it to 200,000. And next thing you know, they leave Robinhood, they transfer that money over to Fidelity or TD Ameritrade or more, let's just call it a brokerage that's been around for a lot more that people have more trust with, right? And so when you have all those negative headlines, it also makes folks that are with other brokerages say, why would I want to switch to Robinhood? Like for me personally, why would I want to switch to Robinhood from Fidelity? To me, it would seem like nothing but a huge downgrade for me, like a massive downgrade. Like go from Fidelity to Robinhood, and especially with the stories I've heard over the past few years, something like that would just not make sense. So that's one thing to factor in. Second thing to factor in is keep in mind there's a ton of new investors that came to the market over the past year. And when you're talking about a ton of new investors, Robinhood's going to be the one that benefits the most from that, okay? And I can tell you that huge gauntlet of people is done now, okay? I have actually a perfect gauge on this. I see my stock market for beginners type videos, how those are performing. And I can tell you, it's just not performing great right now. There's not a ton of new investors coming in the market right now at all, okay? And I have a perfect gauge of this all the time. Right now, the people that are in the market are experienced investors. People that have been, I don't mean like they've been in for 100 years. I mean like people that have been in for a minimum of 12 months. That's the most of the people in the market right now. This is not a time period that we're going through over the past few months where it's like a bunch of new investors. So if there's there aren't a bunch of new investors, essentially you're in a situation with a company like Robinhood where it's tough to run up your user numbers. And this isn't just an issue for Robinhood. This is anything in the fintech space. People had a lot of time on their hands the past 18 months. A lot of time to just kind of think about like, what am I going to do? Oh, I got a stimulus check. Where should I put the money? Oh, let me look into crypto. Let me look into stocks. Let me sign up for Robinhood. Let me watch some videos, right? That's all gone. No, I shouldn't say it's all going away. It's all gone. It's done. Okay. And until we get a next big influx, which who knows when that will be, companies like Robinhood definitely are going to have some trouble getting big numbers of users. And a company like Robinhood is running on user numbers right now. This is not a money-making company, so it's not like you'd be like, well, they make so much money on the bottom line. No, this is a user growth story at the end of the day, right? And keep in mind, the majority of money for this company came from either payment for order flow or from crypto, okay? In their last quarter, by far and away, crypto and payment for order flow. If those, and there's a lot of worries about compression of crypto over time as far as that bid and ask and what these companies can make off that. It's another thing to consider there. And then you got the payment for order flow, which, all of a sudden there's talk about maybe the government wants to outlaw that or limit that or change regulations around that, or maybe they want to tax that, So there's so many negative things here that there's nothing that interests me with Robinhood. I mean, absolutely nothing. Not to say it can't be a good stock. It's just for me personally, is nothing that I look at a $38 billion market cap and I'm like, I gotta go buy Robinhood tomorrow. It's such a great deal. There's not one ounce of me that feels like this stock is anything special, at least right now. Maybe in a few years, maybe they change a lot, maybe they get a lot better business model, I don't know. But as of right now, a money-losing company that I think is going to run into a lot of user issues, that has government looking at them, that has a lot of distrust with their own clients. No, I got to pass on a company like that. So Cathie Wood and me, we don't see eye to eye on this one. If this stock's $21, let's say it's down a little over 50% from here, I'm intrigued. If I can get it under a $20 billion market cap, I'm intrigued then. I might be a buyer. At nearly $40 billion, nah, I'm good. It's not worth, the risk reward's not there for me in this one, okay? So that's that one. Now let's get into the last stock of these three stocks that Cathie Wood is actively buying right now. This one is not talked about very heavily at all, and it is the chef. I'm just kidding, okay? I'm just kidding. Short sellers, the shorts, okay? I'm just kidding about that, all right? I know you guys get too serious sometimes. Just kidding. It's not the chef, but could you imagine? Oh, man. Imagine the video I would make that day. I would just be screaming in it, okay? But anyways, third stock up here. This is not a stock that's talked about very much, okay? It's JD.com. JD, this is a huge e-commerce company out of China. And, if you ever hear about stocks out of China, for the most part, you hear about Alibaba and you hear about Tencent. You hear about Alibaba, Tencent. They're talking about those all the time, right? JD kind of just goes a little bit under the radar, but they're honestly have done an amazing job of executing that business model. $125 billion market cap today. P/E ratio, not crazy at all for this company. Keep in mind, JD is supposed to grow revenues 20+%. 20+% they're expected to grow revenues in 2022. Okay. And so I look at this one and I look at how well run the company is. And I'm actually, let's put it this way. Okay. Now I did a video on Alibaba 6 days ago. I know a lot of you guys saw that. A lot of you guys enjoyed that. I'm super happy you guys enjoyed that video, looking at Alibaba stock there. Okay. And giving my 2 cents there. So Alibaba, if you told me I had to buy a Chinese stock of some kind, tomorrow or whatever, right? I'm buying Alibaba, right? That's my first stock I would buy if you forced me to buy a China stock, right? The second one, if I really, really, truly think about it, I think JD.com. Like if there was a second stock, you're like, you got to buy 2 Chinese stocks tomorrow, I think it would actually be JD.com. Baidu, Baidu's had some trouble over the past few years of really growing their business, right? JD has not for the most part. If I think about Tencent, Tencent's cool, but it's almost like a conglomerate. So many different business lines, so many different things they're into outside of just gaming. So I like Tencent, but at the end of the day, honestly, if I was forced to buy another Chinese stock, it would be JD.com. Now, keep in mind that personally, I'm not buying any Chinese stocks because there's, I got into a lot of that in the Alibaba as far as essentially the elephants in the room. And if you haven't got to check out that video, check out you're at all interested in Chinese stocks. Check out that video, even if you're not interested in Alibaba, and go to toward the end of the video. I get into the 3 elephants in the room, and you got to hear those 3 elephants in the room because they're worth discussing. Before you ever think about putting any money in a Chinese stock, you have to think about the 3 elephants in the room. Okay. And so JD has me interested, but it doesn't at the same time. You know why? Because it's a Chinese stock, and you got to find out for the 3 elephants in the room, guys. Hope you enjoyed this video. As always, if you're looking to apply for our brand new course, How to Invest Like a Pro in 24 Hours or Less, check out the pinned comment down there. Much love as always, guys, and have a great day.